Is the first lecture in financial accounting for chapter 1. I am going to post various lectures for each chapter, and I'll also go through various exercises that will help you complete your homework assignment. And my hope is that it will really help you understand the chapter. What we're going to cover in this chapter is listed on the next two slides. We're going to talk about the two functions of a financial accounting, which is measuring and communicating. We're going to talk about business activities that financial accounting measures and how we communicate this information through financial statements. Then we'll talk about the role financial accounting plays in decision-making processes. There's so many decisions that are made through financial accounting, and we'll talk about how that plays out. We'll talk about GAAP, what GAAP means, and the role of GAAP within financial accounting. Slowly we'll highlight on some career opportunities and what we call the conceptual framework used to develop GAAP. Those last two items we're just going to lightly touch on. There's a lot to cover in this chapter, and I'm going to really focus on the highlights that I think would be necessary. Many people think accounting is math. Well, it involves numbers, but it's a lot more than just math. It involves really analyzing information, measuring it, and being able to put it down on paper for end users. So we're going to talk about why accounting is more than just math or numbers. The two functions of accounting, financial accounting, include measuring transactions, or as we call them, business events, and then communicating those transactions, all in what we consider financial statements. Now you'd wonder, how can accounting communicate that information? Well, hang in there, and that's what this book or this course is all going to be about. You'll be amazed at the end of this course how much gets communicated in financial statements. People make decisions all around us, and people use financial statements in order to make decisions. This shows you a list of items, but I'm going to highlight on some of the key ones here. Many individuals invest in stocks. Now, in 401k plans through work is a very common manner in which most individuals invest in stocks. Google, Sun, Microsoft, Dell. How does an investor decide which of these four companies am I going to invest in? Well, generally, those financial statements are going to communicate a lot about the health of a company. And generally, the better the company is in its earnings potential and price of stock related to the earnings potential is really where people are going to put their money. So this is an area where decisions are made. Creditors, banks. In Minnesota, we are big with Wells Fargo. Not as much Bank of America, but these are some large banks, and they lend businesses money. How do banks decide who to lend money to? Well, banks use financial statements to decide, is this company an acceptable risk for us to lend money to? Local communities deciding on various environmental issues. Well, oftentimes, not all, but many times they will use financial statements in order to help curve and decide their environmental stance. So with the financial accounting, we have investors and creditors. These individuals, they come from various sources, make decisions about various entities, companies, nonprofits, governments, and these companies have to measure activities. They measure activities, and the accountants help define those measurements. The accountants put those activities into a specific format, and then from there, they communicate through financial statements that information to the investors or the individuals that utilize that information. This is the financial accounting framework, spelled perfectly in this form. In accounting, we focus on two aspects. One aspect is called managerial accounting, and this course deals with financial accounting. Managerial accounting is information we provide to internal users. So it is the same process. We measure and we communicate, but it's for the purpose of the internal users to make decisions for the well-being of the company. For example, do we produce more of type A product or type B product? Which of these products gives us a better return? Do we need to purchase or manufacture various aspects of the product? These are all managerial accounting decisions. Financial accounting, which is what this course is all about, is information we are going to provide to the external users. So what that means is it's not individuals within the company. There are people outside the company, such as banks, such as the public, to determine, hey, do we want to invest in this company? It could be government officials. It could be the state. It could be the IRS determining, are they paying their fair share? So while the concept of the information in gathering, measuring, and recording is similar, we focus on a very different aspect of material. So for example, managerial is much more detailed material for a specific department, where financial accounting is very broad. It's the big picture for the public. So in this course, we are going to look at the users of financial accounting, and we're going to focus on various business activities. And we're going to look at this business activity, how do we measure it, and then how do we communicate this activity. Hang in there with me, guys. Let's do a question here. I'm going to have these questions throughout the course just because it will help you understand some of the quizzes that you'll be going through, and it will help you process as we're going through the chapter the correct answer. Which definition below best describes financial accounting? Is it A, the process of measuring income taxes owed to the government? Well, again, if we talked about the broad perspective or the deep, detailed perspective for within the company or for the public, that would be something within the company. So that would not be financial accounting, that would be managerial accounting. B, the system of maintaining communication with the company's customers and suppliers. C, procedures designed to enhance the company's image to potential investors. Or D, measuring business activities and communicating those activities to external parties. Well, if you chose D, you got it right. Here's another one for you. Financial accounting does not deal with which of the following: measuring a company's economic activity, providing information to internal users, preparing financial reports, or communicating financial results to investors. Well, if you heard me discuss the difference between managerial versus financial, remember that managerial deals with the internal users and financial deals with external users. So the only one that financial accounting does not deal with would be providing information to internal. So we are going to take some time and look at the various business activities that this financial accounting measures. Now, as you see here, this is a conglomeration, unifying of various activities. We've got operating activities for a company. So if we're dealing with Caribou Coffee, the operating activities would be the revenues brought in from the goods that are provided and the various costs that go out related to running those stores. The investing activities would be manners of purchasing long-term assets for investment purposes for the company, exclusively for the company. Financing activities are manners in which they receive funds to carry on the day-to-day operations. Usually financing is through loans or through equity, stockholders' equity. Then, in order to do all of these three types of activities, we've got various environmental factors that play out, plus the company. What are their goals? What are their strategies? What are their ideals behind this company? So all of these come out into creating those activities and then measuring them. So we're going to talk in detail about activities, business activities, by taking a golf academy. So we've got Mr. Eagle Eye interested in creating or starting his own golf academy. And in order to do this, he needs funds. You know, you just can't do much around here without some funds or money. So he's deciding that he needs about $35,000 to get this business off the ground. How does he get $35,000? Well, I think he can reach out to some of his close friends. That would be investors to give him money. He's thinking he's going to use 25 or try to get 25,000 by reaching out to friends and having common stock. So Mr. Eagle Eye thinks 1,000 shares of common stock at $25 a share would give him 25,000. The difference, the 10,000, he's going to get from the bank. He goes and he's recruiting. He's cashing in all of his IOUs or his kind gestures. Grandma and Grandpa Q decide they're going to donate $7,500, which equates to 300 shares at $25. Then Ed himself, Mr. Eagle Eye, the business owner, is going to invest $2,500 into this business, which would be 100 shares at $25. Ed's parents got snookered into the deal. So Eagle Eye's parents are going to invest, same as the grandparents, can't be outdone, $7,500 or 300 shares at $25. Then Ed's friend, Mr. Bogey Boy, doesn't do as well as Mr. Eagle Eye, decides he's going to invest 200 shares at $25, which would be $5,000. Then his old high school coach just can't say no. He's going to put in the last remaining $2,500. So as you see here, the various investors have come up with the amount for equity, the 1,000 shares of common stock. As you see, Grandma and Grandpa, 300, Ed, 100, the parents, 300, Bogey Boy, 200, and the coach, 100. 3, 4, 7, 8. 1,000 shares at $25 a share gives him the 1,000 shares he needs, or $25,000 in equity, and the remaining $10,000 he will borrow from the bank. So let's just think about this transaction. he needs 35,000. He's going to get 35,000. Cash is going to increase by 35,000 because he's going to get a note from the bank of 10, and all of his buddies are going to contribute 25,000 into this business. They are going to become shareholders of the company. So 35,000 of cash will increase by 10,000 as a liability and 25,000 as equity. Now, in going about this business, he knows right off he needs some equipment. So he is going to purchase $24,000 worth of equipment for his school. So he is going to purchase the $24,000 of equipment by utilizing his cash. So as you see, in the Eagle Golf Academy's resources, there's cash of 11. Remember, he started with 35, but he's got 11 left over of cash, and he has equipment of 24,000. And then how this money came about, or these resources came about, was through a loan at the bank of 10,000 and through the shareholders or the investors of 25,000. So as you see here, the resources to start this business are 35,000. The claims to the resources, which is his loan, and the shareholders or the investors that are investing in this company are 25,000, which total 35,000. So the resources are 35 and the claims to those resources are 35. Hang in with me. Hang in there. One very important idea of accounting is called the accounting equation. What this states is that assets will always equal your liabilities plus your stockholders' equity. Another word for assets would be resources. They will always equal those claims to resources. So let's take our example of the golf company. The assets that we're referring to, or the resources, include the cash of 11,000 and the equipment of 24,000. So for this specific business, if we look at this accounting equation and we look at just the resources include the cash of 11,000 and the equipment of 24,000. On the other side of the equation includes the liabilities or the creditor's claims and the stockholders' equity section or the owner's claims. Based on our example of the Golf Academy, we know that they borrowed from the bank $10,000, a loan, which is a liability, which means they owe it back. They have to pay that money back. That is a creditor's claim. The bank has a claim on that money in regards to this business. Now, all the various buddies of Ed's contributed money into stock, which equated into stockholders' equity, and the owner's claims because they own a piece of this company. The owner's claims against those resources are 25,000. So as you see this accounting equation, assets, or as we call them resources, those items that benefit a company that are used for the company's purposes equal the creditor's claims along with the owner's claims. So you see how we balance. Our resources of $35,000 equal our liabilities to the bank of 10 and our stockholders' equity of $35,000. So, as we move on, assets are resources of the company. They can be used simultaneously. Liabilities are creditors, are claims to those resources. God forbid if this company goes defunct, the creditors have a right to some of those resources. Then, stockholders' equity equals the owner's claims to those resources. There are $25,000 of the equity section, the claims to resources, that are by owners, $10,000 that are by liabilities. So the owners have claims to those resources, $25,000 worth. As you see here, you can change up this accounting equation. Up at the top, we show assets equal liabilities plus owner's equity. You could also say assets minus liabilities equals owner's equity. This is just a basic math problem where you can take those various variables and move them over to various sides of the equation in order to answer the part that's missing. So, for our purposes, we always say assets equal liabilities plus owner's equity. But if you're looking for the stockholders' equity section, you can say, and take it over, the liability section over on the other side, and say assets minus the liabilities equal stockholders' equity. Or, let's say you're looking for the liability section, you could say assets minus the stockholders' equity equal liabilities. I'm going to take a break right now and start on a new slide so you have time to absorb this one.